What will you do when the bubble bursts?
Lollipop, lollipop, oh, lollipop.
Hi everyone, I'm Mark Lichtenfeld, Chief Income Strategist of the Oxford Club. Welcome to State of the Market, and if you haven't yet subscribed, go ahead, click that subscribe button. It's absolutely free, and this way you'll never miss a State of the Market video. Well, the state of the market is strong. A little too strong, maybe.
I'm too strong! Too strong!
The prices of many assets are through the roof at ridiculous levels. Cryptocurrencies are at highs, including what are affectionately known as shitcoins.
What does that mean?
And these are coins where it is widely acknowledged that they have no value, yet they're being bid up to ridiculous valuations on the greater fool theory, which is, I know it's garbage, but someone else will pay more for it than I did. Well, that's going to end well, right?
Oh!
Stocks are also at all-time highs. The S&P 500 is trading at 29 times earnings. That's nearly double the historical average of 16. The price-to-book ratio is 4.9 versus the historical average of 2.9. And the last time it was this high was in 2000. And we know how that worked out.
All right, now everybody, get in crash position.
Housing prices are off the charts. There are stories in many areas of people buying homes sight unseen, paying huge premiums over the asking price. There's actually a house in my neighborhood that is for sale with an asking price that is nuts. And I told my wife, if they get it, we're selling. And she asked me where we'd go, and I told her, I don't care, we'll find a small town somewhere until we figure it out. So anyone out there with any suggestions on a great small town, leave your comments below. I'm actually completely serious. Now, last week, I covered how to handle losing trades. Today, we're talking about how to handle winners, how to protect your gains so that when the bubble bursts, you keep most of your hard-fought profits. Remember this, though. While last week we discovered how painful taking a loss is, it's also not easy to sell when we have a winner. We're filled with cheer and positive emotions, and no one wants to make that stop by selling. Now, even though we put money in our pocket, it's still the removal of a positive emotion, which makes it harder to pull the trigger. I mean, what if the stock goes even higher and I miss it? So put some tactics in place to remove some of that emotion and ensure you get out with the gains you deserve. One technique for handling big wins in the market is to sell a portion of it, especially if the investment has doubled or more. That way you can sell half or even less and take your risk capital off the table and let the rest of it run. It's much easier to give an investment plenty of room when you can't lose any of your original investment. So say for an example, you have an options or crypto position that's up 200%. Okay, it's tripled. You could sell 1/3 of it and let the rest move higher. And at some point, you could decide to take another third as profit, and the remaining 1/3 still has the opportunity to move even higher still. But if it goes in the wrong direction, you've already put profits in your pocket. Now, another favorite technique is to use a sell stop, and that can be based on a percentage from the high or a point on a chart. But the important thing when setting a stop is to stick to it. No changing your mind as the stock gets close to it. There's a reason you put the stop where you did, and you were thinking clearly when you did it. If you're considering ignoring it, it's likely you're caught up in the emotion of seeing gains evaporate or having to take a loss. Get over it, and as I mentioned in last week's video on losses, get out. The stop will protect your profits. Now, on stocks and calls, you could buy puts as insurance. On a stock, you could also sell a covered call as long as you're okay with selling the stock a little higher from current levels. But if the stock slips, you get to hang on to the money you collect from selling the covered call, and that can offset some of the downside. Now, the hardest one to handle is real estate. How do you hedge the leap in price of your primary residence? Well, in reality, it's very tough. You could short a REIT ETF, but that's not going to give you strongly correlated protection. You could also short a bond ETF because if interest rates go higher, bonds will fall, and higher rates should be negative for housing prices. Or you could take the money and run to a less hot real estate market like I'm considering. Again, leave your suggestions in the comments section. I'm dead serious. For more wealth and income building ideas, click on the link below. I'm Mark Lichtenfeld. Thanks for watching State of the Market. I'll see you next week.